Mullen Automotive is a company that has been providing top-notch automotive services for decades, and Mullen has established itself as a trusted name in the industry with a focus on delivering quality and reliability. The company offers various services, including routine maintenance, repairs, and customization work, all performed by highly trained and experienced technicians. Furthermore, the company was in the news recently due to a planned reverse stock split that would have consolidated its shares. However, the proposal was rejected by shareholders, and the company's stock saw a boost of 10% in the following week, according to S&P Global Market Intelligence. And today, let's talk about the news about the stock split and whether you should buy shares of Mullen Automotive. In a recent shareholder meeting, Mullen voted on the possibility of a reverse stock split. The outcome was that they had no current plans to implement the measure. In addition, it was not stated how many shareholders voted for or against it. Over the past year, Mullen's stock has consistently been below the $1 per share minimum requirement for listing on the Nasdaq. And staying listed on the stock market is important for a company's prestige and future fundraising efforts. Mullen is also part of the Russell 2000 Index, which tracks small-cap stocks and requires a minimum share price of $1. Keep in mind that stock splits, whether standard or reverse, do not alter the worth of an investor's shares or the company's market value. It only changes the number of shares and their price. However, a reverse stock split is seen as a last resort for a business and usually happens when the company is facing the risk of being removed from the stock market. And experts think Mullen must get back on track before it's too late. If you're considering investing in Mullen Automotive, you should keep a few things in mind. Although the low stock price and market cap of around $600 million might make it seem like a good opportunity, there are some red flags you should be aware of. Firstly, there have been long-standing issues with the company that hasn't been fully addressed. Secondly, there's a third issue that hasn't received much attention. Considering this, you may change your mind about investing in Mullen stock. And it's important to approach this risky electric vehicle stock with caution, even it may seem like a good small speculative position. The goal is to make an informed decision that aligns with your investment strategy and risk tolerance. So, investing in Mullen requires accepting certain risks. First and foremost, the company has a history of operating at a loss. This trend is expected to continue in the future, as stated by management in their going concern warning. And in the past fiscal year, the losses amounted to $97 million, which was 4 times higher compared to the previous year. Now, before we continue, I'd like to thank you for getting this far. And if you want to know more, then make sure to watch this next part. Another risk is the company's tendency to dilute its shares. Over the past year, the number of shares has increased from 23.4 million to nearly 1.7 billion as a result of convertible debt and new shares being sold to cover losses and finance acquisitions. And despite losses from shareholders, the company is proposing to increase the authorized share count, which still requires approval from shareholders. Mullen Technologies Incorporated has recently been facing some challenges in the market, which has dampened the outlook for its stock. The company has reported heavy losses, which have led to increased shareholder dilution. This dilution has a negative impact on the value of existing shares and limits future growth opportunities. But despite these setbacks, there are still investors who remain optimistic about Mullen's future prospects. They believe that the success of the company's electric vehicle initiatives, particularly the Mullen 5 electric SUV, will far outweigh the near-term losses and dilution. However, this optimism may be misguided. It is highly unlikely that Mullen will be able to secure the capital needed to scale up production and bring its EV plans to fruition. Companies like Lucid Group and Rivian have secured billions in capital from high-profile institutional investors and strategic partners. Unfortunately, the capital sources Mullen has access to are not as deep-pocketed. This makes it unlikely that the company will be able to raise enough funds to make significant progress. Instead, Mullen may only be able to raise enough funds to keep its operations running, but not enough to achieve its goals. The company may need to resort to dilution, but it is unlikely that this strategy will lead to profitability. An expert from Cambridge said avoiding Mullen stock is the best option due to various factors. He also said the stock is not a good investment and is expected to become cheaper over time. This means even if the share count amendment passes, which may lead to more dilution, it won't improve the situation. In fact, a post-split Mullen may become more susceptible to a sell-off caused by short sellers as a higher stock price above $5 per share makes it easier to short. Future dilutive capital raises are also likely to be ineffective, as the raised cash will be used quickly with little to show for it. As of February 8, 2023, Mullen Automotive Incorporated had a market value of $703.6 million, which placed it in the top 59% of companies in the automobile and truck manufacturing industry. Unfortunately, another expert said Mullen Automotive has not been profitable over the last year, so its price-to-earnings ratio cannot be calculated. And in the last 12 months, the company's revenue was $0, and it did not have any profit margins. Moreover, the company's sales growth in recent quarters has not been significant. At present, there are no analysts who have provided predictions for Mullen Automotive's earnings in the current financial year. Additionally, the company does not currently offer a dividend to its shareholders. Now, the automobile industry, which is known for its ups and downs, has been struggling due to the COVID-19 pandemic. The pandemic caused factory closures, decreased customer visits to dealerships, and disrupted the supply chain. Furthermore, the demand for semiconductor chips has skyrocketed, leading to a shortage in the auto industry. As a result, the sales of light vehicles in the United States are projected to be lower than the pre-pandemic level of 17.1 million in 2019. In 2020, the sales of light vehicles in the US reached their lowest point in 8 years, with only 14.44 million units sold. However, the recent positive changes in the economy, such as an increase in GDP, consumer stimulus, and low unemployment rates, could help boost sales. Additionally, currency fluctuations will affect companies' profitability, with companies with significant manufacturing operations outside of the US potentially benefiting from a weakened US dollar. Cost-cutting measures taken in 2020 and increased production levels may also improve margins, but rising labor and raw materials costs are a growing concern. So, what are your personal thoughts about Mullen Automotive? Do you agree with experts saying it's not a buy? Let me know what you think in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Additionally, are you worried of a market crash? Then make sure to click and watch this video right here and enjoy. And that's the end of this video, guys. See you next time.